Now here we're going to pivot to the U.S. and we want to look at, where some of the economic indicators are pointing and ways that could be adjusted. Now, we obviously, as we said on the EIA show, gasoline prices have started to come down, but diesel prices have come down, but not at the same rate. And that's going to be the problem when you look at the cost of stuff in the store, the cost of stuff coming to your home. And, gasoline is typically helps bridge and push some of the sentiment higher. But I think it's still elevated. It's still at a point where people are starting to get concerned about their jobs, about their financial conditions. And diesel is going to keep the price of everything else elevated, which is why we talk so much about sticky inflation versus flexible inflation, where gasoline falling within that flexible side. And now diesel is also falling under the flexible, but it's an input to things that are sticky. And that's where we don't see that adjusting. So when you look at this, economic strength is waning substantially across the economy, with confidence sagging the most. Industrial data surprises have managed to stay in positive territory for now, but it's bumping along the bottom, and we do see some of that pivoting as retail slows and inventories build. You're going to cut some of your industrial production. You're going to cut some of that. But housing is the one that continues to move negative. And we don't see it moving much deeper negative in the near term because we are in core buying season for homes. It's something that we think will fall as we progress forward. Now, when you start looking, I should say progressing as we go into fall and actually falling more than what is normal during that time of year. Now, the leading indicators contracting, so the LEI or those leading indicators, they are already in contraction. And the ISM is moving rapidly in that direction, with the LEI as essentially an advanced indicator showing that things are moving in that direction. And now, is the economy in a recession? And 30% of people have said yes. So this is the view that we are already in a recession. Not that one is coming, but 30% of the people are saying that we are already in a recession. And I would fall under that category. Now, when you look at July, when you look at where things are, what is the definition of recession? And for us, it's that negative growth, which we do think we have in Q3. As we've been saying, Q2 does come in as positive. And this is some of the pain that is happening, is the monetary base is coming out. They're draining some liquidity from the system. There's still over $2 trillion in the RRP. So there's still a significant amount of liquidity in the market, but you can't, you can see how quickly it increased. But for fear of creating and seizing up the system, you can't take it out the same way you put it in. And that's why the pressure is going to be there for an extended period of time, which is why we keep talking about this extended slowdown. And some of the comments were interesting this week. The common view was that, if you shut your eyes for 12 months, it'll be fine. And then, after 12 months, we're going to re-enter this massive bull market that will continue for years. The question is, though, what was the drawdown in that 12-month period? What was the drawdown that you took? Because at what point do you see pain and people panic? And when you look at where the monetary base is, when you look at where rates are, where inflation, we continue to believe that inflation is going to be sticky. It's going to be a frustrating overhang for this Fed. They're going to have to raise rates. They're going to have to get a bit more aggressive. Then when you look at loans maturing in 2 to 3 years make up 12% of the $1.4 trillion market, double the proportion in 2018, according to Barclays. Loans due in 1 to 2 years have jumped nearly threefold to 6.4%. So this, there's a maturity wall. So the problem is when you look at it, there is a recession coming, so you're going to have to kind of manage your books. But when you look at where the maturity wall is for these loans are coming due. So if you look at, you're expecting your business to slow, so you need money, but you're going to have to borrow this money at a much higher rate than what you currently are paying right now. So the business side of things is going to get worse just in terms of your margin profile, your revenue profile, because the interest expense is going to go up. That's going to be an overhang for the business. So then when you start looking forward, the China Caixin PMI advanced 3 months have a little bit of a bounce. We expect that to come down a bit, but still remain in positive territory. But it just shows the pull it's going to have on Chicago data and other data in the U.S. as, again, we are close trade partners with the U.S. Dallas Fed, already in negative territory, and it's just showing that there's going to be more downward pull on the manufacturing side. Again, all of this showing that anchor and that move lower. So now when you start looking at factory orders, they were expected to be at 0.5%, came in at 1.6%. It was strong on the factory order side. Some of the orders front, that industrial front, continues to be fairly strong, which was a nice surprise. Mortgage applications took a huge hit. It came down, they're negative 5.4%. Again, that leading indicator showing that people just don't want mortgages. That is, again, that leading piece that we keep talking about that has actually now brought down mortgage interest rates to 5.3%. But still, I don't see that as a buying opportunity just because housing prices have barely budged, and that's where people are going to get stuck. Global U.S. services PMI came in at 52.7, was expected at 51.6, bringing the composite, which was expected at 51.2 to 52.3. And then the ISM services index was expected to be at 54, came in at 55.3. And remember, this is June. So we've been saying that Q2 was going to have enough capacity to see that strength, but all the leading indicators are showing that pressure to the downside. Now, the Challenger job cuts year over year is up 58.8%. Again, the number sounds big. The percentage sounds big, but the number isn't as big. But it's still a shift. You're still starting to see those job cuts increase. You're starting to see some of those pressure points. The trade balance was expected to be at negative 84.7 billion, came in at 85.5 billion, slightly better than last month, but slightly worse than estimates, and it's all going to be a matter of factors. But then the initial jobless claims starting to creep higher. It was expected to be 230, came in at 235. Continuing claims was expected to be at 1.328 million, came in at 1.375 million. Again, some of these pivots are starting to show their cracks. Now, somewhat or very difficult to meet expenses when you start looking at, okay, jobs are slowing. Now people are sitting there saying, well, it's getting a little bit harder to meet expenses. People have tapped their credit cards. They've tapped savings. Now they're sitting there saying, there's really nowhere else I can go. And it's getting very difficult to meet my current needs, which is why when you look at University of Michigan Sentiment Index going through a floor and the Russell 1000 Index trailing 12-month gross profit, you can see that there's typically a fairly tight link. And now you have this alligator mouth, which we do think collapses. And it's going to be a bounce in consumer sentiment. Like, it's not going to be all of the Russell Index coming down. But as people see gasoline prices coming down, a little bit less pain, that'll again bring some of that, but it just also means that gross profit is going to come under pressure as people continue to struggle. Now, earnings recession is coming, as we were saying. When you look at the model estimate based on Alpine Macro, we agree with where this is in terms of what the trend is going to be as margin is compressed, as we have more pressure, which again is going to lead to more problems. But the Challenger job cut side. So when you look at it, job cuts spiked 58.8% year on year in June versus a negative 15.8% in prior month. It's the largest jump since December of 2020, with the auto sector announcing most of the cuts of 10,198. So again, it's just, is this the start of something? You started to see it slow down a bit, over the last 2 months, and now you're starting to see some of the pressure pick back up. Now, when you look at the job opening side, on the JOLTS side, JOLTS job openings fell to 11.25 million, still above the estimate of 10.9 million, but it's below 11.68. So openings rate moved down from 7.2% to 6.9%. Quits down from 2.9 to 2.8. Hirings unchanged. Separations unchanged. Layoffs unchanged. So again, you're cresting. You're sitting at a peak, but what does that mean for a recession? Do we need jobs to roll for a recession? And so Liz from Fidelity, I think, did a great job, and she did it, and I retweeted it, So this is a great chart where when you look at where things are, when for the recession being obviously the red line, you can see that jobs either started to crest or actually still rose into the beginning of a recession. So the fact that we're starting to roll is actually a perfect timing to say, hey, we're in one. Like we're there, and you don't need to see jobs go down and then a recession. It's really the jobs coming down is the result of the recession. The jobs isn't the driver of it. So, and that's where you get more of a lagging indicator. So again, it's just the roll, slight breaking down. It just means that we could very well already be in one. So, as I said so I'm just going to quote myself, and as one of my friends always says, Cato loves quoting Cato. So I think it's a very important point when discussing when a recession has begun or if one is around the corner. Jobs can keep moving higher or remain stable even as growth moves negative. It is why we discuss so many different metrics and data points when viewing the global economy. So when we look at the thread on labor and recession, many often ask how recession can be close when jobs are still being created. But reality is payrolls are coincident with economic growth, often contracting when a recession has already started. So when you look at, for an example, in the 1970 recession, payrolls didn't peak until March 1970, 3 months after a recession started. In 1973, in the 1973 recession, payrolls didn't peak until July of 1974, 7 months after the recession started. So that's what we keep looking at. That's the pain that we keep talking about, where it's not like, oh, we're in a recession, so then jobs have to collapse. No, it's people still have jobs. Companies still need things getting done. They may not just need as much of it. And that's when you look at the pressure that we remain in, why we think that we're going to be in a sloppy decade. I mean, when you look at the 70s, you had almost three recessions in a very tight bandwidth. And then over a 15-year period, you had 4. So I think when you look at rates, when you look at inflation, when you look at these issues, and then you look at just how high we are and how elevated we are on multiples, on multiple expansion, on the market in general, there's a lot of pressure to the downside. So then when you start looking at U.S. personal savings, the survey was for negative 0.3, came in at negative 0.4. I'm sorry, personal spending. So you can see that we're well off of trend. We're negative as personal spending continues to contract, and we think that accelerates to the downside as this series only goes back to the great financial crisis, but confidence among families making over $75,000, has plunged to the worst since September of 2011. Which again, people are just seeing the problems that we've been highlighting and again, feeling that pain. But there's that divergence in bank deposits by income percentile. So wealthy deposits have surged. Now, given this is from Q1, this is already reversed. We've already seen all of this come down a bit, but you still have it elevated for some. And while those in the bottom 20% have already reversed course and are in a downward move and seeing more and more pain, and we see that increasing, not decreasing. So the problem is the people that are at the higher end of that level are seeing their stocks get cut, their homes come under pressure, some of the leverage that they have. So they're contracting a bit, obviously not to the same level as others, but again, you're starting to see some of that cracking, which you can see with the small investor interest in high yield debt increasing, because people are like, all right, well, let's readjust. But you can see that when you look at the market in general, a huge surge in activity of learning more, trying to invest, and you're seeing it, but at more of a measured pace as that concern remains around, how much free capital do I have? How do I reposition my book? So smaller retail traders, investors are gaining interest in high yield debt. Overall, though, search interest volume in investing has fallen considerably over the past couple of years. Again, as that fear and as people are like, well, the volatility is killing me. I just can't manage this anymore. U.S. real consumer spending, when you look at the overall shift, the durable goods coming back down, services continuing to creep back up, non-durable, we continue to see services again moving further up as we see some of that roll, but then the real disposable personal income is firmly in a negative growth, shaking out the trend line, which is why real consumer spending is going to continue to contract holistically. Pieces of it will remain elevated, but again, moving in that direction as you get some of these pressure points. And a lot of this is driven of the concern about your job, the concern about labor, some of these shifts that we're seeing, which again is going to accelerate, which is why with US GDP being so heavily reliant on the US consumer, as that pivot starts to happen, that's when you start to see, before you lose your job, I mean, for those that have ever worked, that it's like you get a sense that something's wrong. Either with the way people are treating you, the way you're seeing people act, and it's usually clear that there's problems. And you can sense it. You haven't lost your job yet, but you're like, something is not right in the universe. And that's when you start to like, okay, well, people are acting a little funny. I'm not going to buy this coffee. I'm not going to go out to lunch. I'm going to skip dinner going out to dinner this week. And that's when, you start to see that curve. And then as it comes to fruition, people tighten further. And again, that's where that labor connection really sits. So then when you look at government transfers, continues to fall. For nearly a year, government transfer payments share of personal income has been declining, now at 17.8%, which is the lowest since March of 2020 when the initial surge happened for COVID. And then savings rate ticked up to 5.4% in May, a touch higher than 5.2% in April, but it's still clear that the savings boom is over as we are back to where we were in essentially 2009, 2010. So again, you're seeing some of those pressure points continue. Forward-looking indicators point to weakness in the U.S. factory activity in the months ahead. So again, the data was good in June, but leading indicators pivoting and now looking in Q3 and Q4, we see that pressure coming on the ISM manufacturing side, looking at cyclicals, defensive ratios, all of those new orders, new export orders, all of the employment, CapEx. Again, so even though June, as we showed earlier, was positive, we expect that to reverse. Inventories at U.S. retailers also moving back up, which again is going to put that downward pressure on industrial activity. Then when you look at ISM, June ISM services, you can see kind of where things sit, but business employment went negative. So when you look at new orders dipped to 55.6, supplier deliveries edged up to 61.9. So again, still slower deliveries, new orders slowing, backlog spiked, which is a small positive. Prices paid eased a bit to 80.1, but still very high. And unfortunately, employment fell back into contraction and is at its lowest since July 2020. So then when you start looking at the divergence, when you look at the drop for ISM services employment component into contraction territory, it just doesn't bode well for new orders, because if you're firing people, it means that you see new orders coming down, especially if the former remains under 50 for that foreseeable future. We expect to see that contraction, and we expect to see new orders continue to diminish. So ISM services business activity sideways, prices paid came down, but when you look at it, it's come down, but still high, still in that stagflationary band that we've been describing. All the while employment coming negative, and then job openings. So you have employment negative, so you already have contraction, and then job openings starting to slow. So employment coming down, job openings coming down. Again, all of these things pointing to some of that additional pressure on that front. Well, new orders to production. So the spread between ISM manufacturing new orders and production has dropped sharply into negative territory, now at the lowest since October 2009. Again, leading to the problems that we've been discussing. May manufacturing orders, again, this is the positive 1.6% versus the estimate of 0.5. Orders ex transports 1.7 versus 0.6. Year-over-year growth softened a touch, but again, still remains strong at 14%. And this is the one that, based on the what's to come, is where we see some of this pressure. But still, as we've been saying, it's not going to go away all at once. It's just that rate of change is going to come down and start to move a bit more negative. and all the reasons why. Energy, goods, and services spending is quickly growing as a percentage of consumption and is now at its highest since November of 2014. And again, we don't see that changing. Even as gasoline prices come down, you're still seeing energy, goods, and services, and especially on the services front, going up, which again is going to take away more of that disposable income, tie up that capital that would have been spent elsewhere, and that's going to put that pressure on the consumer. And now the change in monthly visits to the mall continues to trend lower. That's indoor, that's open air, that's outlet, all moving in the wrong direction as we progress through the summer months. Again, just showing some of that leading indicator data. ISM manufacturing was expected at 54.5, came in at 53. Again, moving down to that negative, but then the leading indicators, new orders expected at 52, came in at 49.2. Orders to inventory ratio, again, coming very moving in towards negative territory. So manufacturers see new orders as being low relative to inventories. PMI supplier deliveries getting better, still elevated but improving. Prices paid, again, staying in that tighter band, showing that stagflationary front. And then when you look at expecting less in the biggest metros, home sellers are cutting prices to attract buyers. But again, you're cutting from a very elevated number. So there's still more meat on the bone and more room to fall given where we are on that front, which we think is going to continue. All the while, after years of declines, home listing inventory is finally rising. For a number of active U.S. listings, jumped 18.7% year on year in June, largest annual increase going back to 2017. New sellers entered the market at a faster rate than before the pandemic housing rally began. But again, a percentage of a low number is going to be a big percentage. So it's also a mixture of there was just less buyers, more sellers, but you're still in a fairly tight market. It's just you're starting to see the swing. And for us, it's more of that trend. And you could see the trend really pivoted when we were talking about it, 6 months ago. The trend pivot was real, and people doubted us, but here we are, and that's why we do see more downward movements. And then demand destruction, when you're looking at the largest weekly drop in 30-year mortgage rates since December 2008. So you're already seeing a big drop in mortgage rates. And again, you just went from 6% or 6.13% to 5.3%, but it just happened in a straight line. You're still high versus what you could have gotten of, just under 3% 6 months ago. It's just, again, that percentage movement. It's still meaningful, but we want to see what that trend looks like, as we do remain concerned about the housing front. So that's what we have for you on the U.S. In the next segment, we're going to go deeper into Europe and what is happening in the European continent.